The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Good evening, it's that time of the week again when we get together to talk about property and of course answer all of those questions which you have about the topic. Tonight I have two expert guests joining me and standing by to take your calls. But first to the news, and the Perth property market has continued to slow with a huge increase in the number of homes for rent, new figures show. The Real Estate Institute of WA figures show there has been a 50% increase in the number of properties for rent in the past 12 months, jumping from just under 4,000 to almost 6,000. The number of homes available for rent has now jumped 135% since 2013. It is a far cry from the boom times of a few years earlier, when groups of up to 50 people would inspect a home for rent, with many offering more than the asking price to secure the property. The number of homes for sale has increased 20% in the past 12 months, from 8,650 to more than 10,350. At the same time, the number of homes selling has fallen by 15% and are now 5% below their 15-year average. And one industry group has raised concerns the thriving Sydney property market is driving commentary and policy for all Australian real estate. The Housing Industry Association has released analysis suggesting that not all markets are operating at the same level. The HIA's A Portrait of Australian Home Prices report says that after accounting for inflation, capital gains have been subdued across most capitals. It suggests that in real terms, dwelling price growth has been at a single-digit rate in every capital city over the past year, with the exception of Sydney. Outside of Sydney and Melbourne, real dwelling price growth was just 2.2% in the year to June 2014. With me tonight to discuss these stories and answer your questions is Brad Beer from BMT and Curtis Field from Colliers. So if you do have a question for anyone on the panel tonight, you can call us right now on 1330 3435, or you can email it to property@skynews.com.au. Welcome to the program tonight, and welcome to you both.
Good evening, Margaret. How are you?
Good. Curtis, we, a couple of years ago, most of the experts were commenting that they felt that the Perth market was about to enter boom times. It boomed around about 8 or 9 years ago to more than double in value in an 18-month period in a number of suburbs, and almost triple in some. And a lot of people thought that it was on its way back. Rental yields had been down as low as 2.5%. I didn't agree at the time, thought they didn't really have the fundamentals. What do you think's happening over there?
Well, I think the interesting thing is that rental vacancy, which I reckon is a really good indicator, and or the amount of properties for lease in that marketplace. And I think one of the things that you can really look at in markets, and Perth's not a massive market, but when those stats start ebbing and flowing a bit, I think you can actually start to flag that perhaps there is an issue. And we've seen it across a lot of cities, actually, and conversely, when Sydney really took off a couple of years ago, rental vacancies or properties available for rent sort of really blew out again as a lot of first home buyers jumped into the market and left a bit of a vacuum behind it. So I think it's a good stat to look at. It's probably not the greatest, it doesn't cover all scenarios, but Perth is certainly a market which has had that massive change, and really quite a small population with a massive economy driver as well. So it's got some really serious different levers to, say, other capital cities across the country.
I guess, Brad, my point at the time when everybody was saying that it was about to boom, really the basis on which they were making that prediction was that it hadn't been very far in 8 years. My point was that at that time it had already boomed past its sustainable peak. It was in a lengthy period of correction, yet it was still at that point where the average home price was well above what the average income earner could afford, and people were really backing the fact that mining was in town and these miners earn these big dollars, but the miners weren't buying the properties.
Yeah, I think anything that grows ridiculously always has to sort of come back to some sort of equilibrium of real supply-demand. How much stock do we have? How much supply and demand is there? And when it booms so heavily, eventually investors are going to go, well, at 2% returns or 2% yields, it's no longer looking highly attractive. Now, the median price hasn't changed a lot, I think I read in the rest of the article. And that to me says it's not necessarily bust.
Yes.
But you've got to set the rents at a reasonable level that people are going to come and rent if there's too much supply because investors have bought too much, and that's probably where it sits. And so, well, I guess, yeah, and to your point, so many other levers, but Perth's not a small country town either.
No.
So it's got more than just a little bit of mining, I suppose, to drive it.
True. I guess one of the things that we can take from this, one of the lessons for investors who are all hopefully watching tonight, is that the first thing is that we shouldn't be relying on a single industry to continue to fuel an economy, because if we do that, then that can be quite a weak economy. Ultimately, it can be a great economy, but it can also have weaknesses or cracks. The second thing is to realise that the fundamentals that drive many of our markets today are investors, and if investors aren't seeing the yields, then they're not going to invest. They have to invest elsewhere. And
they probably won't keep putting the pressure on that market like they did, because it's so moving, and we tend to operate in herd mentality as investors in this country so regularly that it starts moving, people start buying, keep pushing it too hard, and then suddenly the yields are really low and people realise that it's not really that good anymore.
So, Curtis, do you think that's what we're headed for here in Sydney? I think there was a massive grip of FOMO in Sydney, fear of missing out. I think investors and owner-occupiers alike dove into the Sydney market thinking, I've got to get in on this. It's a great thing. Property values are going to skyrocket. Initially, the people who got in early, of course, saw some good gains in a short period of time, but most people came in at the tail end of that. And do you think the same will happen here now? We pushed those prices so far that yields are now relatively lower, and now we're going to see a period of adjustment.
Well, I think one of the things that people look at, and the yield is a great measure, but it's also the expectation of capital growth. And I think when we've had that big swing of capital growth, like you've mentioned, and there is that sort of jumping in, that there is going to be a balance out, because it's going to get to a point where everyone that's on the table that wants to be involved in that market gets involved very quickly, and then the new entrants who aren't as pent up replace them slower. Therefore, that demand sort of does start to slow, and the backfill of, particularly for investors, as particularly first home buyers move out of the market, who are the traditional renters, then there's less people available for the demand of a rental property, and next thing you know, rents start coming back down again. So I think there is a natural ebb or flow in the market, in the market, but I also strongly believe that you can try and regulate a market or do something with the market through grants or interest rates, etc. But at the end of the day, purchasers will make their decision up about what is value and what is not, and they'll talk, walk and talk with their feet, I suppose.
Sounds a little bit like the block last night, where we saw flow and then ebb all in a 10-minute period. Well, in our first email, Damien raises an interesting question, and he says, for the next generation, do you see properties in areas where employment opportunities are currently limited, but the facilities, views and houses are beautiful as potential hotspots? Going forward, I believe there will be a significant increase in telecommute opportunities. I know that my company can be run from anywhere with an internet connection, and I choose where I stay based on how beautiful the area is, not proximity to the CBD. I like this email, Brad, because as you would know, this has been a little soapbox I've been on for quite a long time now with investors, trying to get them to understand that the CBDs are one thing, but we will move toward a period in the future, probably 20 years down the track, where flexible working opportunities, the internet, the way we do business changes completely, and people will do more and more working from home, and therefore choose to live in areas where they don't have to fight the commute and live in shoeboxes.
I think our technology gets so much better and blows you away every week. Some of the discussions I have with people about the technology and the way that we even run our business and what we do changes so rapidly. And I don't have to see people that get a depreciation schedule organised, for example, now. In the past we may have done that sometimes, but I do have to go and visit the property. But really, most of the process is easily organised, and many more companies are becoming more like that. You know, how many more things are actually bought on the internet instead of retail at the moment, so you don't need to go to those places. And so there is the ability to probably live in these areas that are wider, that are much more beautiful and sometimes, and don't necessarily have that 2 hours of commute. I do, however, note on that I think, is it Google that have gone back from working at home all the time to bring people back in? It was one of those large...
Yes, I did. I saw that.
So is it going the other way, and how are we making it work?
Hard to say. Look, I know we have a couple of staff who have a couple of days a week from home, Curtis, and they're more productive for us, and we find that, you know, they appreciate that, and they actually give back a lot more because we're flexible with them.
Look, we're always on. You know, the phone's always vibrating, people are answering, you know, emails at midnight, all the rest. I think the reality is workplaces are becoming much more flexible, and someone was telling me the other day that there was a recent study that people who work 1 day a week are actually more at home, actually more productive than someone who's in the water cooler chat and all that sort of stuff. So I don't know anybody who doesn't work from home, whether it's, you know, 1 day a week on a weekday or, you know, in the middle of the night or whatever it is. But I think that flexible workplaces are impacting on that. And you look at places that are lovely places to live, like in Sydney, up the northern beaches, where people commuting into the city every day, it's madness. But when they have that flexibility, I think the home office is I think going to grow and grow and grow.
Yeah, and so I think in the future we're definitely going to be looking out, Damien, to those outer suburbs and to those large regional towns where people can get their lifestyle needs met, particularly as the Gen Y, Gen X and Gen Z come through. They're very much thinking about their lifestyle first and their job second, and they are going to be choosing those areas. There's something to be said for investing for the future in the kinds of areas that people will want to live in the future. Well, it's always great to have your company, and as you've tuned in, I'd like to make a special offer this week. Everyone who calls or emails and has their question answered tonight will get a copy of my latest ebook. It's called How to Succeed in Property Negotiations, and it's a complete guide to negotiating on your next property purchase. Now, if you can save thousands on your next buy, you'll recap or reap many times that in ultimate capital gain. So call us on 1300 30 34 35 or email property@skynews.com.au with a question, and then make sure you watch at the end of the show to see how to get your book. We're off for a break. Don't go away. When we come back, we'll take some more calls and answer your questions. Welcome back to Your Money, Your Call. Tonight you're watching depreciation expert Brad Beer from BMT and Curtis Field from Colliers. So get to your phone now and call us on 1300 30 34 35, or of course you can email us on property@skynews.com.au. Jasmine, how are you going, Jasmine?
I'm good, Margaret. How are you?
Good, thank you. What can we do for you this evening, Jasmine?
Yeah, Margaret, I have moved to Australia with my family around 2 years ago. And me and my husband have invested in few properties in Sydney.
Okay.
I've heard the experts on the panel suggest that one should diversify the portfolio and invest in properties in other cities like Brisbane and Adelaide. I would like to know what would be the best way to invest there. Would you advise me to travel there to have a look at the properties, or is there another way?
Okay.
And also, sorry,
yes,
what is your opinion on areas like Camden and Bradbury in Sydney, which are comparatively affordable but not very well connected to the CBD by trains?
Okay, I'm going to split the question in two and give part of it to each of you. Brad?
Didn't get any of that.
Okay, so, your earpiece fell out. Okay, well, the question is, this lovely lady has invested in a few properties in Sydney, knows she needs to diversify. bit nervous about investing when she can't see the properties. Should she be flying around to Brisbane and Adelaide to look at the properties, or what is another way that she can do this?
Very good question, Jasmine, and I am probably one of those people very guilty of investing in areas I know. That's why Margaret will throw me that question.
Not that you know, that are near you.
Sorry, that have been near me and therefore knew the area probably a little bit better. However, I have also widened to invest in other areas, largely because I have a big land tax problem and from discussion from people over time. And I've bought properties since that I actually haven't looked at. Used to be that I always go and look at the property, etc. And since then, being busier, etc. And yes, there was probably a little bit of fear associated with that at the start. But with the proper reports that you should get anyway from building and pest inspections, and the fact is you've chosen the area and you've chosen things about that property that you should be making that decision based on, and actually going and seeing it is probably shouldn't really change your decision too much, other than the research that should already have been done before you actually bought that property. I suppose one difference is when I've been renovating, then I like to see what I can do with it, I suppose, as well.
Now, Curtis, just quickly, Bradbury and Camden, what do you think about those as areas to buy?
We talked about the southwestern suburbs in Sydney a couple of weeks ago, I think, and there was some pretty good discussion around that, and the fact that obviously the connection down into that growth centre down towards Canberra, but also potentially benefit from the second airport, etc. I think, Camden is probably a little bit disconnected and probably a little bit too rural, and has a little bit more lifestyle type of properties to be looking at. Bradbury, slightly different profile, and I think that whilst might be attractive from a price point of view, there's probably better areas in that southwest corridor to be looking at that have similar sort of entry points. And I just think that again, the fundamentals have got to, you've got to look at it. The capital growth stats of those two areas probably haven't been as strong as some other areas in that southwest corridor.
Yeah, look, I agree entirely, and I would think that better areas to invest than Camden and Bradbury at the moment are definitely in Brisbane, and there are some parts of Brisbane that are poised to take off from a capital growth perspective and from a rental growth perspective, because there's just so much infrastructure, there's not enough land, there's a burgeoning population, and we can see already that they're starting to experience some good growth in their properties. It probably won't quite reach the fever pitch that we've seen in Sydney, but you'll get some good buys from there. As to buying without going and seeing them, I absolutely think you shouldn't be flying around. First of all, the costs of doing that are not tax deductible, even though it is because you're buying an investment. Unless you actually own an investment that is income producing and you're flying to see or do something to do with that property, then you don't have a deductible cost on your hand, and therefore you're spending money and you may not buy anything. Make some friends with some real estate agents, make some friends with some property managers, because you can often get a property manager to go out and look at a property that you may be interested in and give you an idea on how it would rent, whether it needs anything done. Get some good pest and building reports done and learn how to invest without looking at those properties. I bought 40 properties and haven't looked at any of them before I bought them, and I wouldn't have been able to build a portfolio like that if I was endlessly flying off all over the country trying to find those properties. And as Brad points out, that whole land tax issue, be careful. If you have a few properties in Sydney, I'd venture to say you're already in land tax territory. You don't want any more of that. It's time to take a break, but while we're gone, you can still phone and join the queue. Remember, every question answered tonight will receive a copy of my brand new ebook, How to Succeed in Property Negotiations. Call us now on 1300 30 34 35 or email property@skynews.com.au, and make sure you watch at the end of the show to see how to claim your book. We'll be right back. Thank you for staying with us. I have some great expertise tonight on the show. Brad Beer from BMT and Curtis Field from Colliers are in the studio and doing a great job answering your questions. So call us right now on 1300 30 34 35 to join the queue, or you can email us on property@skynews.com.au. Tanya from Melbourne, how are you doing, Tanya?
Yeah, good, Margaret. How are you?
I'm good. What can we do for you?
I have a property. It's in Paddington in Sydney. I bought it in 2008. Briefly, it's a 3-bedroom, 3-level home, self-contained unit out the back. I paid 3.6 for it. I still owe 1.1 on it. I'm getting very good rent. However, I've sort of come to the point where I'm trying to decide, and have been for the last year and going into another year now, of whether to maybe offload it. I've been advised that I'd probably only get back the money that I actually paid for it.
Okay.
However, over the last year, the property property cycle up there looks a lot better now, so it's more encouraging. I need to sort of work out whether or not to offload the property now, hold on to it for another couple of years, and if I offload it, am I better off sort of putting, the money that I can take out of it after I pay off the mortgage into something else?
Now, did you say this was in Paddington?
Paddington, yes, correct, yeah.
Okay. I guess, first of all, I do have to stress that we can't give advice to disinvest for someone to sell on this show. I guess we can make some general observations about the Paddington market, which surprisingly, I'd have to suggest that if Tanya can only get back what she paid 3 years ago, she may have overpaid a little bit 3 years ago, because Paddington has moved a little in the last 3 years. Curtis?
That's what I would have thought as well. I mean, Paddington's one of those markets which has seen, I would have thought, has seen pretty good growth in it. I suppose one of the things that bumps into my head in that decision-making process is, and this is probably something that Brad can talk to, is there an opportunity, to renovate and reposition the property and then get some depreciation around that? But I've got to say, firstly, that I think it's unusual to have an investor sitting on a property of that sort of value, and I would think that maybe looking at alternatives where that equity might go to could actually probably get you a better yield and get that money working a bit harder. So that's my gut feeling, to really have a look at that, because the yield on a $3.6 million property compared to a $800,000 property may be substantially different for you, and actually, like I said, the money start working harder.
Yeah, I guess, Brad, a couple of the important things that I think Curtis pointed out then is that investors generally don't have all of their money in a single property of $3.6 million, albeit a small debt of 1.1, where there's a fairly low yield, which the yield's probably covering that low debt, but you can't look at that. You can't say, well, my rent's covering my expenses. You've got to be able to say, is this particular property having $3.6 million in the market actually getting me that kind of return I need in both growth and in rent return? And
that's the big thing. It's not about the actual debt. I think it's about the actual amount of borrowing capacity that's probably tied up there.
That's tied up.
Exactly. A fairly large value sort of investment property that we don't see too often. If I looked at all the depreciation schedules we've done, then the amount of residential properties of that sort of purchase price, there'd be a very small number. And the big thing is really just, I think, assessing, if you were to sell that property, what is your borrowing capacity like? Because getting some more debt against that to get some more borrowing capacity is going to be hurt by your ability to service any debt and not actually get some more yield out of that particular property. And at $3.6 odd million, it's $6 or $7 $500,000 properties.
Yes, exactly. All with probably a 5% return each. So on that, then you get 5% on the entire $3.6 million instead of what's probably about 3, I'd say, in Paddington.
And sort of reduced risk because you're spread as well. You're not in that top end market that probably is probably quite damaged by any downturn in market. The top end seems to sort of hurt a little bit first. So looking at spreading is probably something to consider.
Yeah, look, I think you definitely need to seek out a qualified property investment advisor who doesn't try to sell property to you. Get your entire situation looked at. There could be a better way for you to invest your money at the moment. It could be a good time to get out of the market when you're not paying big capital gains tax. I hope you'll stay around while we go to this very short break. And don't forget that I'm in a generous mood tonight, and if your question is answered on the show, I'm going to send you my latest ebook, How to Succeed in Property Negotiations. Call now on 1300 30 34 35 or email us on property@skynews.com.au. Thanks for staying around. You're watching Your Money, Your Call. I'm Margaret Lomas, and with me on the panel tonight is Brad Beer from BMT and Curtis Field from Colliers. Now, if you have a question that you think we can answer, call us now on 1300 30 34 35 or email us on property@skynews.com.au. Before we do go to callers, let me tell you about my latest offering, my new ebook, How to Succeed in Property Negotiations. Now, I've found that most people don't negotiate well, and even those who think they do could do a lot better. If you can save money at the start of your investment, then this will compound over time to mean even greater savings. This little ebook will show you how. How to Succeed in Property Negotiations is available now from my online store for a special price of just $7.95. So visit destiny.com.au and go to the store for your copy. Jill from Brisbane, thanks for hanging around, Jill.
Hi.
What can we do for you?
We'd just like to know your opinion on Kippering in Brisbane. We have a house which we're either looking at selling or renting out for 12 months. There's a railway station that's due to be completed in 2016. And there's also been a lot of money spent on the new shopping complex nearby.
Yes.
We're only about 20 minutes from Brisbane and 5 minutes from the beach. We'd just like to know what your opinion is on the peninsula area just north of Brisbane. Should we hold this property or rent it out?
Now, Jill, is this a home of your own that you're moving out of?
Yes.
So do you still have debt remaining on that property?
Small debt.
And what will you be doing when you move out?
We've bought another house already.
And does that have debt?
Yes, it will have.
Bigger than the one that you're moving out of, I would assume.
Yes.
Okay. Okay, gentlemen, Kippering, up around the Redcliffe Peninsula, part of the Moreton Bay Shire, and quite a go-ahead area. However, does it make sense to keep this house, Brad?
Look, your big problem is you're raising a debt against another principal place of residence or not an investment property, which will be non-deductible, and you're going to have a low debt left against an investment property that would be deductible if you had a decent-sized debt against it. So the issue is a tax issue for you, not on whether to sell now or to sell in really 1 year, because you are going to start paying a lot of interest on the, I assume, better house that you've bought that's worth a little bit more money that is no longer deductible. So, and when you calculate those numbers and what your after-tax income is going to look like for a year, it could be a situation where you're better off actually selling, because you can actually then push money against your principal place of residence and be able to invest in other property potentially if you've got enough money left over. And from a tax perspective, that will probably work a hell of a lot better for you, from what I can see there.
And what do you think, Curtis?
Oh, totally agree. I mean, yeah, it's the age-old question that we get, and we find it with people all the time. You know, if I can change a property from being my principal place of residence into an investment, and then, you know, the triggers that happen with that, you've got to be really, really careful about it. But, you know, as a property itself, the fundamentals are there, you know, everything that we love to hear about, you know, investment in infrastructure, the retail, all of that's fantastic. I mean,
I think it's true though, isn't it? People get caught up with the house they're moving out of, and even though in this case there's some fundamentally good things about the area, which often there isn't, people still do want to hang on to that old house they're moving out of. They're quite emotionally connected to it, and they want to keep it as an investment. I think you have to be careful of a number of things, and I'm going to draw on all of the information that I get out of the tax experts that are in my life here, because I'm not a tax accountant, but it depends on your timing here as well. Hopefully you haven't moved out of it yet, and hopefully you haven't actually finalised the sale of the new property. You have what's called a 6-month overlap rule, whereby you can have 2 principal places of residence and claim the exemption on both, but you may not go 1 day over 6 months. So hopefully that hasn't occurred yet, and you still have time. Why I'm saying this is because you can then get out of the property that you're currently moving out of and pay no capital gains tax because it's your principal place of residence. Pull all of the profits that you've made from that after you pay off the debt, tip that into the new property, which can become your new principal place of residence, and therefore then you've got all of the equity where it needs to be in your own home debt as low as it can possibly be, and draw back from that to buy more investment properties. Rarely does it work to mix the two up together, but I think you need to get some really good advice from an accountant here to find out what's right for you financially. those financial circumstances must be considered over and above whether or not your old home exists in a hotspot or not. Once the financial considerations are thought about and taken into consideration, you can then decide what the best thing is to do with your old former principal place of residence. Well, Anthony has been told by his accountant to cut his tax bill by buying a property, and so he's asking, my wife and I are currently renting on the Sunshine Coast, where we have a contract to work for the next couple of years. As beautiful as it is, we aren't keen to settle here long term, and we don't see any advantage in investing in a holiday market. As both of our salaries jump up a tax bracket this year, our financial advisor has suggested that we look at the idea of finding an investment property that we can depreciate. With the Caboolture market having been mentioned on your show previously, I've been doing some research, and there are plenty of new and established properties that are competitively priced. Do you have any thoughts on purchasing a new versus a property, old property in this area to rent out? Okay, now one of the things that always worries me is when people's financial advisors tell them that they should be buying property to cut their tax, or if their accountants tell them that. And secondly, when people buy property purely because they're chasing tax deductions. Brad, what do you think of this scenario?
Look, I'm someone who prepares those tax or some of those tax deductions for clients all the time, but I'm still not a believer in buying a particular property based on depreciation or based on how much depreciation you're going to get, or based on just tax reasons. Now, choosing a property should be about creating future wealth rather than about your tax problem now. The fact is, a tax problem helps you with that cash flow on the way through. So if you're looking at two properties, one that's newer definitely will get more depreciation if it's next door to one that's older, but the newer one may be more expensive. So there's a lot of things to consider. It's like depreciation is one of those things after that purchase or before that purchase to think about, but not really to make that decision unless you're comparing two comparable properties.
It's like the icing on the cake, isn't it?
Yes, and it does definitely help the cash flow substantially, and near or near new property makes a big difference to that, but shouldn't be the only reason to make that decision.
Brad, I've seen people buy property for the cash flow, never considering the fundamentals of that property, and all they get for the rest of their life is good cash flow on a property that never does any good. It never grows, and they can't. When they get out, they're just back to where they were. They haven't actually created a nest egg.
And you've got to have cash flow to service the debt, or to like. If you run out of cash flow or places to put tax deductions, then you run out of purchasing power.
Yes.
And therefore you run out of leverage, and you run out of the ability to create wealth out of that property. But you've got to have some sort of balance of that cash flow mixed with capital growth you believe is going to happen over that time. And the tax incentives just help that cash flow.
So having said all of that, Curtis, Caboolture, of course, is right up the top there of the Moreton Bay Shire. A little disconnected, but not much, from that whole growing area that includes things like Kalanga, Murrayfield, I always forget the M1, and all of those kinds of areas that are the beneficiary of the Bruce Highway extension and lots of infrastructure. What do you think of Caboolture?
Look, I don't mind it. I think, you know, we've had calls before about it on the show, which Anthony's referenced, and you know, it's a good location for many of those reasons that we just mentioned. The good thing I like about your email is you're actually putting it out there that you're not getting caught up in the whole lifestyle issue about buying a property. You're not falling in love with a location because it's somewhere that you're just going to be with for a short period of time. You're actually looking at them as fundamentals and saying, well, you know, where is somewhere which has actually got some growth in it? So I think, you know, on the Caboolture side, it's a tick from me, but also I actually like what I'm hearing in terms of how he's selecting his property and making his choices.
Yeah, I agree. Look, I think Caboolture is a little bit of a medium to long-termer. I think if you're looking for something that's going to grow immediately, which you must look for something that's going to grow, but to look for something that's going to grow immediately, you probably need to move a little bit further out and go somewhere maybe around Deception Bay and Rothwell and those areas there that are slated for growth sooner than Caboolture would. But if you are going to buy in Caboolture, where you can get a really good yield at the moment of around about 6.5%, I think you just need to be a little bit careful, because there's ample land available. There's a lot of new releases, and some of those properties that are house and land packages are priced considerably above, with a builder's premium, than something that's only a couple of years old that might have very close to the same depreciation on it. So maybe shop around and have a look at some of those established properties. You may get a better bargain on those. You may find some people more keen to move on price as well, since all of those new areas are opening up. But definitely along the way you'll get those tax deductions. You will get a good rental yield on it, but you do need growth as well. Never, ever forget the growth. Well, what a great night we're having with some great discussion, but we do have to take a quick break. We'll be right back. And remember that every question answered tonight will get a copy of my latest ebook, How to Succeed in Property Negotiations. So while we're gone, get to your phone and call us on 1300 30 34 35 or email us on property@skynews.com.au.
In the first place with
Great to see you back here on the Business Channel. I'm Margaret Lomas, and joining me tonight on the show is Brad Beer from BMT and Curtis Field from Colliers. Now, if you have a question too, call us now on 1300 30 34 35 or email us on property@skynews.com.au. Now, Warwick lives in Dubbo, and he's written in to ask, my family and I are looking to move to a new principal place of residence in Dubbo, New South Wales, and make our current principal place of residence in Dubbo an investment which would generate positive cash flow. We also have another investment property in Dubbo. My question is, do you think I should sell my current principal place of residence before buying another and then purchase an investment property in an alternate location? My overall goal is to own 10 properties over the next 10 years. Appreciate any help the panel can provide. I guess we need to say here, Curtis, refer to the last...
Yeah, refer above.
Refer to the last caller.
Yes.
So what would you have to say?
Yes. There we go. Sell the principal home of principal place of residence and look at that scenario for all the reasons we just previously mentioned. However, the just as important is your question in relation to diversification and all your eggs in the Dubbo basket, as we would say. So now would be a good opportunity for you to look outside those shores. And you know, whilst Dubbo has the F word, the good fundamentals that we always talk about, I think going back to one of the lead news stories that Margaret was talking about. The rate of growth that we've seen in some of the country towns and smaller cities across Australia, and particularly New South Wales, has not kept pace with other cities. And we've talked about places like Brisbane tonight, which could be somewhere to look at. And you don't need to travel there either. You can buy it without looking at it.
You absolutely can. You know, Brad, the interesting thing is that Dubbo's okay, and as far as an investment location goes, you can get some good cash flow. But I think its growth opportunities, while they exist, I think they're limited in relation to some of those capital city suburbs that we definitely have up and coming at the moment.
And you're also fairly heavily invested into Dubbo already, so looking outside, you will eventually get into land tax territory is one problem. When we look at the sort of areas that have been asked questions and seem to have some fundamentals for potential for growth going forward, or that we believe do, then Dubbo doesn't seem to raise its head as number one on the list. And being a sort of smaller country town, I've had some of these experiences with properties I've owned that seem to sit there and tick along slowly. And they return okay, but they never seem to get that whack of capital growth that you can get in sort of probably sometimes some bigger centres.
Absolutely. And you know, Warwick, I guess the reason why moving out of your own home and having a positive cash flow property, the reason that exists is probably because your debt's quite low. You'll probably move into another principal place of residence with a big debt. And as we've said to former callers or previous callers tonight, you need to be careful that you're not upside down financially. You too need some good advice from a good qualified property investment advisor, but you also need to start diversifying, get out of Dubbo. Nothing wrong with Dubbo, so you know we do love Dubbo. However, we don't love everyone putting all of their eggs in that Dubbo basket, as Curtis has rightly pointed out. Steve from Sydney, how can we help you, Steve?
Hi Margaret, good evening panel. I've got a main principal residence where I'm living at the moment, but I've also had a block of land for about 10 years and I'm at the finishing stages of of subdividing it where I can put 2 separate houses on it. Now, how does the depreciation work with the cash flow, with the rent that I'll be getting, and plus the depreciation? Is there a 5-year schedule, or how does it work out?
Okay, well, I guess in a nutshell, Brad, without sort of getting too much into the detail,
Yes.
I suppose we need to talk about, first of all, capital costs or capital works deductions,
Yes.
and then plant and equipment. Very quickly, if you'd like to explain.
Yeah, for sure. Steve, look, you've built new properties, so there's 2 areas of depreciation, and one is what's called the capital works allowance, where you'll get 2.5% of the actual construction cost of the structure of that building, and then we put some value on all the plant equipment items, carpets, hot water services, stoves, blinds, and etc. And you get some deductions in relation to those as well that are higher. They have a shorter life, so we calculate that depreciation that exists. Now, it's not 5 years necessarily. There's actually claims in total for 40 years against that structure, and different items of plant and equipment have different rates where we claim those over, 10 or 12 years, or depending on what the items actually are. You'll have that rental income. This will be one of the deductions that do go across that property after you have that rental income from it, and will work against your other income basically as a non-cash deduction for those properties after you've completed them.
So it can be pretty good, really. You get the 40-year deduction on the structure is the same every year. But the plant and equipment can be different every year and for shorter times, and some are 5, some are 10, some are 2, some are 1.
Yes, so...
Straight away.
Yeah,
it's like so much that you could never work it out for yourself.
Yeah, that's right. Now, the structure part is not necessarily so difficult because it's a total and it's 2.5%, same amount every year, 40 years.
Yep.
Every one of those other items that we identify there have, whatever the years are in deduction, the method we come up with to value those things for the purpose of depreciation is a bit different than just the, going down and buy your hot water service at Ream, for example. And making sure you've got all those things accounted for properly is an area that we see often not done very well, so we help people to do it.
Now, it's important that he gets this done as early in the piece as he possibly can, probably just after he finishes the building.
Yeah, because you'll have those deductions as soon as it's available for income-producing purposes. You might be able to adjust your tax on the way through to have less taken out of your income, but we'll calculate what those numbers are for you so you can get it correctly sorted out.
Yes, and Steve, you can absolutely claim those deductions along the way by completing an income tax withholding variation form. Get your accountant to help you with that. When you complete that, it takes into account all of those figures that Brad will give you in your depreciation report, and it allows you to claim those tax deductions every week in your pay, or however regularly you're paid, weekly, fortnightly or monthly. It can be a good idea because when you get your tax back at the end of the year, the tax office doesn't send you interest on your money that they've been holding, but if you get it back every week or every fortnight in your pay, then you can use that to even offset some interest if there's any debt in that property where you're building, and certainly help you with your weekly cash flows without you having to pay out of your own pocket, which can be great. And on a new home, the depreciation is going to be fairly big, and so that weekly deduction is going to be quite a large deduction to you, and well worth taking the time and the small cost that it costs you to get an accountant help you get the ITWB form filled out. Well, thanks for tuning in tonight. It is time for our last break, but when we return, we'll of course take some more calls and read out a couple of more emails if we have time. To have yours answered, simply call us now on 1300 30 34 35, or you can also email us on property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and it's certainly been a great night with my expert panel, Brad Beer from BMT and Curtis Field from Colliersl. Now, we have only a few minutes remaining to squeeze in this last question, but there's always next week, so you can email me through the week if you have a question which we missed tonight. And Bill sent us this quick question on yields. He asks, what yields should I expect when buying a property? Well, that's almost like how long is a piece of string question, isn't it? It's probably good to talk to Bill, Brad, about how there isn't a consistent yield. It's not like saying, well, I'm going to have my cash in the bank and I know I'm going to get 4% or 1% or 2%, is it?
No, it's not, and it depends where you buy, what areas. There's so many variables to the question of yield. I think the important thing to consider when you're asking a yield question is that you maybe need to ask a couple of more questions. When you're looking at buying buying investment property in whatever way, you've got to get some sort of combination of cash flow so you can support these properties and growth. We're buying property for future wealth. We need growth or capital growth, and we need cash flow on the way through. So we're only asking one of the probably two very important questions there that is just about the cash flow. Necessary, yes, but only one piece of a wider picture that needs to be really asked about.
You know, Curtis, I think people get a little bit confused about property yields as well, because to me, there's actually three components in a yield, and I think I'm the only person who ever talks about it this way. The first component is the growth that you get on the capital value. That's a yearly yield, however much it goes up. The second is the rental return that you get. But the third is actually the cash flow created through that depreciation, because some properties depreciate so well that you actually end up with extra money back. And I think when you're adding it all up, you need to add up that cash flow plus your yield plus your growth to get an overall relative yield on property.
Absolutely, and the first you mentioned is almost a silent. It's something that you don't physically touch and taste. You know if a suburb's doing well, if your property's improving in value. But it's interesting, like, we get the question a lot around, oh, what rent are we going to get on this? What should my yield be? And the headline yield, most investors are looking and quote 5 to 5%, 5 to 5.5% as a gross yield. But as we mentioned previously to one of our earlier callers, on more expensive properties, those yields can really thin away because there's just not the same level of demand for a rental property at $1,000 or $2,000 or $3,000 a week. But that doesn't mean a property that's only getting $300 a week is suddenly going to be 6 or 7% yield. So it's there's multiple levers there.
And of course the other thing is that a property that gets a 5% yield could, after all those deductions, be better for you than one that gets a 6% yield, because one's got better deduction.
And your personal situation as well. You know.
And the depreciation that you claim as your third point there is actually related to the construction costs, not necessarily the property's value. So if you spend more in construction, you end up with more depreciation. So your after-tax yield obviously changes a little bit.
Well, hopefully that's been a help to you. We didn't answer your question, but we gave you some things to think about. All good things come to an end, and for this week, so have we. Thanks so much for being here and for the great questions. We'll be back next week with Ben Kingsley from Empower Wealth and Paul Rickard from Switzer, so be sure to tune in then. My guests this week, Brad Beer from BMT and Curtis Field from Colliers, did a fabulous job, and I know they'll be keen to be here later in the year to answer your questions. Thanks also to our callers and emailers for your fabulous questions. Now, if we did answer your question tonight, email me with your name and the question you asked to yourmoneyyourcall@destiny.com.au. That's there on your screen, yourmoneyyourcall@destiny.com.au, and I'll send you a copy of my brand new ebook, How to Succeed in Property Negotiations. If you missed out, you can get the new ebook from my online store at destiny.com.au for a special introductory price of just $7.95. And don't miss your last chance for my essential property education courses held throughout November in Sydney, Adelaide, Brisbane and Perth. Call your local Destiny branch for more information about dates and venues. Thanks for being here. I'll see you again next week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.